Ladies and gentlemen, once again, a very good evening to all of you and a warm welcome to HSBC Premier Market Outlook 2023. My name is Jacqueline Chow. Well, a big welcome to one and all our esteemed guests joining us virtually as well. Thank you for joining us this evening. Now, tonight we've put together an impressive lineup of speakers sharing their perspectives and insights. So lots to look forward to. And to kick us off this evening, please join me to warmly welcome on stage to say a few words, Ashmita Acharya, HSBC's Head of Wealth and Personal Banking. Ms. Acharya, please.
Hello, hello. You know, when you are short, it's always, you need to kind of get this, the mic setting and everything right. But first of all, Jacqueline, thank you very much for the introduction. I think for everyone here, good evening, ladies and gentlemen. I am delighted to be here with you. My name is Ashmita Acharya. I'm hoping I get the right level for the mics. I'm the head of Wealth and Personal Banking for HSBC in Singapore. I joined the bank about 5.5 months ago. In all fairness, because I'm having so much fun, it feels like about 5 years. And every moment, in all fairness, has been tremendously exciting. I come from another foreign bank, and from my perspective, I just want to share this with you, and I think the reason for me joining HSBC, and I think someone asked me right now that why do bankers move around? And I actually don't move around. I spent 20 years at that bank, but I came to HSBC with a very clear purpose because I truly believe for internationally minded customers like yourselves, customers who have wealth aspirations, personal aspirations, transactional banking, international connectivity, there is no other bank right now like HSBC. I know all banks seem similar at times, a little commoditized, quite of similar, but there is something very unique about HSBC and HSBC's commitment to the Asia wealth story, HSBC's commitment to the international connectivity that it can offer, and that is something I truly believe in because, you know, having lived in multiple geographies, I grew up in India, I lived in the UK as a young kid, actually not so young, I had my teenage years. I did my schooling out there, I lived in the US, I've lived in Singapore. I truly believe a bank like HSBC can really offer everything to our clients across the wealth continuum. So again, a very warm welcome. I'm really honored that you've taken the time out to come and spend this evening with us to hear about the Mid-Market Outlook event. I think the theme, Jacqueline mentioned it, is Eastwards and Upwards, navigating market uncertainty. We've all realized that in today's day and age, that is a constant. It's the way I tell, kids nowadays. I have my one daughter, and I tell her, I said, Anaira, in all fairness, like what life will be for you, I don't know. The one thing you have to do is be able to adapt to change, because change is a constant now. And I think for another thing from, and James, who's standing out there, who's the expert, the market expert. I am not at all the market expert like him. But from my standpoint, what I've realized is, over the last few years, one thing which has played out is a level of uncertainty which is here to stay. Because when we started 2023, we all started the year with a wave of optimism. China was reopening, things were kind of settling on the COVID front. We were all happy to just get out there. And there was a peaking of the inflation which was talked about, but then there was a banking turmoil which came in, again from the US and across markets, and it created a level of uncertainty again. And amid all these pressures that we were seeing, which is something which will continue, and I don't think any of us have a crystal ball which gives us a perfect answer. So this uncertainty, this volatility is here to stay. But despite all these unknowns, the one thing which affords, even in these unknowns, is that there is a wealth of opportunities out there. And that is something you need to keep in mind, just the way your own personal, away from the market, your own personal front, you are seeing opportunities. Careers are sort of going away, some professions, some new professions are getting created. We talk a lot about generative AI. I spent yesterday with my team, with the Google, at Google actually, we spent half a day out there listening to Google and talking about what does it mean for a bank and what does technology mean for a bank. So there will always be new perspectives brought in, but at every juncture there will be a certain set of opportunities which we want to be there to show you those opportunities and help you make the decision on those opportunities and whether it makes sense for you. So what is very important, and I always say this, in a way like wealth management is complex, and I think quite often as customers we feel quite inundated with information, and there's so much out there, and how do you digest it and distill it, and how do you make it relevant for yourself? Well, you talk to people like HSBC, you talk to your bankers, you hear people like James who will talk about, as our CIO, like what does it mean for you? What is this, all this information, how does it distill down to something which is relevant for you? From my perspective, what's very important in this uncertainty is that the one thing I know we all revert back to in uncertainties, or kind of like it's like kind of a comfort blanket for all of us, is cash. We always think, you know what, cash is king. In this environment, the interest rate is quite attractive. It's okay. My deposits are earning enough. Let me sit in cash. Well, that is something I really would urge you not to have in your portfolio to a great extent. Because in the end, unfortunately, cash thief, as we call it, is a reality. Because the fact is, even if you're earning 4%, 4.5%, 5%, 3%, whatever it is, the fact of the matter is the inflation rates are actually eating into your overall holdings. So unpredictability is here to stay. What we want to do is work with you on your life journey, because every journey is unique. Each of you are in a different life stage. You have different needs and aspirations, and we want to be your bank, your partner in this journey with you. And we want to keep you informed at every step of the journey. And I really want you to understand that we are not here to talk about products. We are not here to talk about solutions which don't make sense to you. We are here to be your partner in your life journey. It is a long journey that we want you to have with us. We want to be your partner every step of the way, and we really want you to think about what is wealth to you, because wealth has different meanings to different customers, and we want to be able to find solutions which mean the most to you. So in conclusion, from my standpoint, what's most important for all of us is how do we emerge stronger through this entire process. And I'm going to hand it over to James and the guest speakers. As I said, they are about 100x more knowledgeable than I am, so I will not sit here and talk about what the market means and what's out there for you, but I really want them to provide insights on how you can overcome the challenges and find those opportunities which make sense for you. From my perspective, I'm truly excited to be part of the HSBC family. I've really enjoyed every day that I've been here. I know I'm counting the days because I'm literally, it's almost like having a baby, it's joining a new place, excited every moment. There's so much to learn, and there is so much of good work which is happening with the organization. So at any point, I would love to interact with all of you, get to know you. I'm happy to, your RMs know me. So any point you want to talk to me, hear from me on what HSBC's strategy is in Asia, in Singapore, I'm happy to talk about it. So with that, again, thank you very much for your time. Thank you very much for being here with us. Super excited. My team gives me talking points. I never stick to them. So I think they should stop giving me talking points. I'm not very good at it. But from my standpoint, a big warm welcome. And again, as I said, really excited to be your partner on your wealth journey. And over to James. Thank you very much.
Thank you. Thank you very much, Ashmita, for that. Thank you. Thank you. I'll pick up on what Ashmita said. Change is the name of the game, isn't it? So what can we do when things are uncertain? Where do we look for the opportunities? Because they exist. And this is what we hope to bring you during our Market Outlook. Our very first speaker, as alluded by Ashmita, is Mr. James Cho, HSBC's Global Private Banking and Wealth Chief Investment Officer, Southeast Asia. Please allow me to introduce James. Now, James, he spearheads the development of investment strategies across all asset classes for HSBC Global Private Banking and Wealth Management clients in Southeast Asia. From 2004 to 2009, James served as a senior economist at the Monetary Authority of Singapore, where he was part of the team that formulated policy actions for Singapore during the 2008 global financial crisis. Ladies and gentlemen, please join me to warmly welcome on stage Mr. James Cho.
Thank you, Ashmita, for setting the stage, and thank you, everyone, for giving us the chance to host you in this very wonderful venue. I heard that this venue is a top wedding location. I got married 20 years ago, so I don't have the privilege of this venue, but I think tonight we can really kind of sit back, enjoy, hear out the market views in this wonderful place. I started my career about 20 years ago. I started out as an economist. And you know, my routine was very simple. I have 4 screens to capture market movements. So when I go to the office every day, I watch that 4 screens because it will have macroeconomic data that happen in the United States. And I'll try to interpret what that means for Asian markets that following day. So that routine worked out very well. But that routine didn't work out well when 2016 happened. Why? The election of President Donald Trump. Because, you know, he starts tweeting, right? So that 4 screens doesn't capture his tweet. So I have to take out my phone and watch his tweets because his tweets move the market. Then, of course, 2021 came. President Joe Biden was elected president. And of course, President Joe Biden, he doesn't tweet stuff that will move the market. But another guy does. Any guess? Yeah, Elon Musk. So I have to use my phone again and follow Elon Musk. But then I have a friend who covers Tesla as an equity analyst. So he knows Elon Musk, or he knows the company very well. So, you know, in financial markets, I try to get a little bit more information. I asked my friend, how do you follow Elon Musk? Do I just follow his tweets? And my friend, the analyst, he says, no, you want to be a step ahead of market. So you don't just follow his tweets. You have to follow his girlfriend. Wow. Then the next question I ask, which girlfriend should I follow? And you know, very funny, nowadays with ChatGPT, generative AI, I tried to ask that question to ChatGPT, who is Elon Musk's girlfriend? The AI couldn't tell me. And even when I asked the AI whether in the cage fight, Elon Musk versus Mark Zuckerberg, who wins, AI can't say. So at least for now, we still have a job, us analysts, because you know, you still need someone to kind of look after your investments and stuff like that. So I think, although the story I shared with you, it's a joke of sorts, but what's very important is this, is that the thing about financial markets is that there will be changing conditions. The winds always change, but you can adjust yourselves to capture that change. So what worked well last year may not work well this year. And last year, what happened was that we have a situation of rising inflation, rising interest rates. And in that environment, cash did extremely well. This year, the macroeconomic conditions change. Especially in the second half of this year, we are no longer having a rising inflation situation. In fact, across the world, in most places, inflation is actually falling. And that means that central banks in most countries are either going to pause the interest rates or interest rates probably at a peak. And in some countries, interest rates are going to fall. So I think that's a big shift. So now what should I do in this environment? And clearly, I think this year, the strategy has to change because cash is no longer king. And the way to kind of think about it is really through a diversified portfolio. If you compare how a diversified portfolio performs against cash, it always beats cash over the long run. And I think that's very important. But of course, the big question is, how are you going to build that portfolio? And that's what I'm going to show to you throughout this presentation. And if you look through different time periods over the last 10 years, a diversified portfolio always most definitely outperform cash. And even in times during whether it's the 70s or 80s, when cash rate is very high, just like right now, where you could get 3%, 4%, or even 5%, depending on which currency you're investing in for fixed D. Even during those periods, the performance of a diversified portfolio almost definitely beats that of just purely holding cash. Because by holding cash, it gets dragged down by inflation. So I think what's also very important is that we are at a tipping point right now, because in the US, interest rates trajectory, it's very likely that the Fed would still increase interest rates one more time in this July's meeting, but thereafter, it's very likely that the Federal Reserve will start to pause interest rates. And once they pause interest rates, and typically if you look through history, whenever the central bank stops increasing interest rates, it's usually good for financial markets. It's good for equities. It's usually good for bonds. And we are at that tipping point, that whole inflection point. And that's why it's very important right now to start to think about how you could actually deploy your cash. And I think this is the conversation, and this is the kind of that presentation that I want to share with you, some ideas on how you can think about deploying your cash, especially right now when the Fed is starting to peak, start to pause interest rates. But one also crucial factor that you have to bear in mind is that recession really is not our base case. This year, if you have heard me earlier part of this year in our market outlook, I've stated the case that we are not going to enter into a world recession. And sure enough, the world is still growing quite strongly, despite a banking crisis back in March. US economy is still very strong. The consumers in the US is still spending, labor market is still strong, wages are still increasing, unemployment rate is actually falling in the United States. So we have a strong labor market. At the same time, commodity price, energy prices are starting to stabilize. And I think we are at a stage where the business cycle or confidence is starting to slowly pick up. So in this environment, yes, the Western economies will slow down because of that whole credit crunch we saw in the banking sector. But the good news is that non-performing loans in the United States is still very low. And of course, it will increase along the way. But of course, many of the banks are very well capitalized. And of course, policymakers have already stabilized the system in more ways than one. So I think from that perspective, you will see a slowdown in Western economies, especially in the US and in Europe. But the good news is that Asia, many parts of Asia, is actually still growing and fairly strong. If you think about China, for example, China is reopening. I'll speak about that later on. But you have India, you have ASEAN that's still growing very strong in the second half of this year. And I think that presents quite a bit of opportunity. But of course, we live in a very complex world. Many things are moving, and there are many key forces and moving blocks that could actually affect our investments. And I've mentioned that we are in a world of unsynchronized cycle. The West is slowing down. Asia is extremely strong. And of course, you have strategic competition between US and China. And therefore, we are in a very much a multi-polar world, very uncertain, lots of volatility that you're going to expect. And of course, with things like disruptive technology associated with artificial intelligence, the race towards much more stronger computing power, as well as, of course, many countries are pushing ahead in the green transition. So all these are disruptive technology that will shape our investments. And of course, society is changing. Demographics is driving many of the changes. China is aging, for example. But at the same time, India and parts of ASEAN, it's still having a very young population. And of course, you put to that climate change, that's going to be a very big driving force. All of these forces are interacting. And of course, it means that from an investments perspective, we have to kind of think about how we could kind of thrive when all these major forces are working against each other. We think that at this stage, we still want to be a little bit pro-risk. We want to be underweight cash. We want to deploy that cash into high-grade or high-quality investment bonds. In terms of global equities, we were fairly much neutral, but we think that there are opportunities both in the United States as well as in Asia. And of course, with the peaking of interest rates, we think that the dollar is going to kind of move downwards. So I think all these key forces, as it plays its own, as it's kind of have a confluence, Asia is at the center of it, and also Asia could also benefit from some of these big trends. So there are a few actions that you can take away and think about investing. The first action is to capture Asia's upside in the second half of this year. And I think that's very important because Asia is going to contribute more than 70% of economic growth for this year, and there is a good case for re-acceleration of Asia. And bear in mind that Asian equities and bonds are trading at a very attractive valuation. So if you combine a resurgence of growth as well as valuations that's actually very attractive, Asia looks like a place whereby Asia could possibly outperform developed markets in the second half of this year. So this is the first action, the first idea that you can think about when you want to consider about investing. The second reason, of course, is that there are many parts of Asia that's still very resilient. India, for example, has a young demographics. ASEAN with infrastructure as well as investment spending, a large consumer market, and also China's reopening, especially one that's consumer-led, will still play its true for the next 2 to 3 years. So the next action that you could actually take and think about your investing is really about deploying into quality credit. I think that's very important because at this point of time, if we're going to have a conversation 6 months down the road, if you are all invested in a fixed deposit, 6 months down the road, that fixed D rate that you're going to get is definitely lower than now. So you have to think about how are you going to continue to capture coupons or capture a higher rate. And I think one of the ways to do that is through high quality investment grade bonds, because you want to lock it in at say 5 to 6% in a global investment grade bond portfolio, and to hold it out, one with a duration of 5, 6 or even 7 years, and you can lock in these coupons for the next 5 to 6 years. I think that's going to be a very important strategy because it's only this time, this few months, that you have the chance to build that income for yourself. Because if you look at it down the road, if you reinvest your deposits, you're going to have a lower rate. So I think this is an action that you can think about in terms of deploying the cash that you have and to kind of build that income into your portfolios, which is very, very crucial. And clearly that whole shaded area that I've shown in this chart is that opportunity costs if you don't do that. Because if interest rates fall, cash rates fall, that's what you're going to miss out in future. So this is an action that I think everyone should actually think very seriously about in terms of building income into your portfolios. And of course, the next action you have to think about is to kind of build a diversified portfolio, which is actually extremely important. Because in this environment where there are many various forces that could collide with each other, whether it's geopolitics, whether it's macroeconomic risks, etc., you have to have a diversified portfolio. So I think this is one of the most important actions that you have to start thinking about it in terms of building a global equity portfolio that's diversified, thinking about building a global bond portfolio that's diversified. So this is an important action that you have to set out to do. And of course, the next action that you can think about is to take advantage of that whole AI boom that's occurring. And clearly, the tech sector is an area where you cannot afford to ignore. But in that sense, it has run up a lot. So I think this is something to watch out for, something that you can think about participating, but clearly it has run up a lot. So nevertheless, I think it's a long-term trend that's going to occur. It's going to change many industries, as many companies, whether it's in the tech space or in the non-tech space, they're going to employ AI to make themselves much more efficient and much more productive. And of course, with this peaking of interest rates, a strong earnings outlook, we should still see an outperformance of the tech sector. But this is something that we're going to watch out for and clearly in the months ahead. So the big question, of course, is what's happening with China? Is China's recovery sustainable? Is China still a market that one should think about? And what's clear is that China's recovery is still ongoing. It's not like in the past cycle that's very much investment-driven, infrastructure-led. This time round, China's recovery is very much a one that's consumer-led. With reopening, they were locked down for 3 years. They have accumulated almost $1 trillion of US dollars savings, and they will deploy that spending across many years. So this is going to be a big trend that I think will continue on. And clearly, I think the economy of China will continue to grow. We have seen some bumps along the way in the last few months, really because industrial activity, manufacturing activity in China has, of course, slowed down. And that's natural because we saw a V-shaped recovery once they reopened late last year. Since then, economic activity, especially manufacturing activity, has started to normalize. So we think that consumers in China will still spend, but their spending patterns will change somewhat. And there are various ways to kind of take advantage of that trend. But also because of that slowdown in China's consumers, what you're going to expect in the months ahead, and it's what's really happening, is that the Chinese policymakers will start to ease policy to support the overall economy. We are seeing some targeted easing, whether it's through interest rate cuts or even support for the property market. And this is important because property market is fairly weak in China right now. And I think the authorities want to kind of reinvigorate the market so that it creates a little bit of wealth effect for the consumers. When the property price is high, they will feel a little bit wealthier and they will spend more. So I think the property market is going to be very, very crucial. But of course, it's going to be a balancing act. They don't want to kind of increase too much leverage into the property market at the same time. So these are some of the signals to watch out for when it comes to China investing. But also what's very important is that when you look at the second half of this year, the growth of earnings is actually the strongest in Asia. Whether you look at ASEAN, Hong Kong, China, many of these markets are still growing in terms of earnings growth at almost double digits. And this is where we see the opportunities, especially when you compare that to the Western economies that are slowing down from an earnings perspective. So we think that if you combine that with attractive valuations in Asia, especially in China, where valuations are almost during lockdown periods, unless we get a hard landing in China, unless we get a big, steep economic recession in China, then these valuations are what the market's actually pricing for. But if you think that China is still going to grow at 5 or 5.5%, then that, in effect, this is actually an opportunity to think about when it comes to China investing. And when you look at valuations in ASEAN, ASEAN valuations are still quite fair compared to other developed markets. So of course, what's the big outlook for Asia and where are the high conviction opportunities? As much as China's recovery is happening, if you look at the economic indicators, the service side, the consumers are still extremely strong, and they are clearly a bright spot. So we think that you want to look at quality leaders in the consumer discretionary sectors, the state consumer staples in China. We think that some of the high-quality leaders in the state-owned enterprise, particularly in the internet, infrastructure, and some of the telco companies in China looks quite interesting when it comes to China's recovery. And of course, you don't want to ignore the rise of Asia's rising tigers. And I kind of think of the rising tigers as ASEAN and India. A and I, not artificial intelligence, but AI in that sense, because you no longer can just look at China when it comes to Asia investing. You have to consider China plus AI. And AI in this case is ASEAN and India. Why is that so? It's really because of demographics. China is very much aging, but at the same time, ASEAN and India is still having an extremely young population that is growing. And clearly, I think in economics and in earnings and in companies, it's really about that growth of population. And I think that's where you're going to see huge amounts of opportunities when it comes to ASEAN and India, which is going to be, I believe, the rising tigers of Asia in the next decade. And of course, what's also very important is the green transformation, sustainability that's going to be a key driving force for economic opportunities, because Asia will account for almost 64% of the world's renewable capacity when it comes to energy. And in every new car that's being sold in China, 1 in 3 new cars are actually electric vehicles. And this is going to be a huge amount of a big economic opportunity that investors have to think about when it comes to Asia's green transformation. So this is an area that I think you can think about. And of course, it's not limited to just China, but also in India's case, India is ramping up its renewable energy capabilities. So I think this is a theme I think investors have to think and have to consider. And of course, when you start to invest in your bond portfolio, another high conviction theme is that it's not just enough to look at global investment grade bonds. And if you want to get a little bit more juice from your bond investing, you also want to think about Asia quality credit, because Asia bonds does give you a little bit of higher coupons compared to global investment grade bonds. So I think this is something to kind of look out for when it comes to your bond investing. So I think to summarize, I think it's very important to build a globally diversified portfolio. And I think from a position of cash, you should start to think about deploying and locking in that yields 5 to 6% through a global investment grade bond portfolio. I think that's the first action that you can take. And thereafter, you also want some diversity in the equity market. I think in a global equity market context, you might want to think about Asia, especially in China, or even parts of Southeast Asia and India to start that allocation. But of course, in the US, you cannot afford to ignore the US market, especially the tech sector, which is going to be a very crucial component for investors in the years ahead. So I think with that, I will pause my presentation, and I wish you all a very wonderful evening ahead. Thank you very much, everyone.
Thank you very much, James. Thank you for that. Thank you, James, once again. We'll be back later on for the fireside chat. So thank you, James, for taking us through, right, the broad strokes of the market outlook, the 4 key themes as well. Now, we're going to head on next to our next speaker, which is Mr. Subhash Pillai, Regional Head of Client Investment Solutions from Franklin Templeton Investment Solutions, Singapore. Now, Mr. Pillai, he has the responsibility of developing multi-asset goals-based investment portfolios for clients in the region. Now, Franklin Templeton's Investment Solutions business builds on the broad range of investment capabilities within the firm's fixed income, equity, and alternatives investment groups, as well as across third-party managers. Mr. Pillai is also a portfolio manager for a number of client accounts. Ladies and gentlemen, please join me to warmly welcome our next speaker, Mr. Pillai.
Thank you very much for the warm welcome. Thank you very much for spending time with us today. And thank you, HSBC. Thank you, Ashmita. Thank you, team. I was going to thank James, but that was a really good presentation and it's going to be pretty hard to follow. So a couple of things I would say. I definitely do agree with him on the 4 screens. So I, like James, for much of my career, 4 screens, get in there, start at the top left, work my way down. But then things changed. So it was about February 2020. Things were starting to get a little bit weird. I had a former boss of mine that was, in Hong Kong during SARS, and he was getting me worried. And so I suppose my own personal DORSCON was going amber or going a little bit more like that, so we were de-risking portfolios. And I made this move, and it was a little bit preemptive, but the rest of the world followed me. I took 2 of those screens home. And do you know where 2 of my 4 screens remain? They're still at home. And I tried to get another 2 screens and put them on, but my eyes had just adjusted, so I'm stuck with 2 screens going forward. But look, I'm here to talk a little bit about income investing. And before I kind of get into that, what is income investing? Why is that different to normal investing? So firstly, income investing, really when you think about investing overall, your focus is on delivering and achieving a good return relative to either a benchmark or on a risk-adjusted basis. You're not so much focused on when you're getting that return. Is that return capital gains? Is that return income that you're receiving periodically? Is that return a mix of both? Now, with income investing, you're still looking to deliver a strong return over the long term, but you're also focused on the cash flows that are coming in. You're looking to deliver income that can either supplement a lifestyle or also service debt. And so the timing matters. And this results in some different considerations. Now, income investing has been around for, certainly in modern financial markets, income investment has been around since the mid-40s, post-war. It's a very popular way for retirees to invest. It's a very popular way for people that are looking to grow their capital, but also consume from that capital progressively. It's certainly an area that's grown meaningfully as interest rates have risen, as inflation has risen. And so that's why we're focusing on it today. So what are the key elements to income investing that investors are finding attractive? Firstly, it's that income aspect. And in an environment where I think Singaporean inflation is still over 5%. And this is the challenge that Ashmita shared, the challenge that James shared, which is you can invest at a decent return by standards of 2010, right? You can achieve a 4% quite easily, but getting above inflation in this environment is quite difficult. And what income products do, whether or not they're focusing on fixed income or their equity income or their multi-asset income, they're endeavoring to get you that level that will, in most cases, beat inflation, stay ahead of inflation, plus also provide the opportunity for capital growth over the medium term. Now, a second major area of attraction is as interest rates go up, so do borrowing rates. And if you're levered into your investments, then what an income portfolio can do, what an income strategy can do, is deliver a stream of coupons, dividends, realized capital gains in some examples, and give you a cash flow to help service that borrowing that you may have. Now, typically, there is potential for capital growth, but it will typically be less than 100% equities. Most income products that are multi-asset in nature will have betas to the equity market that are about 0.5 to 0.8. They won't give you the same upside, but they also won't give you the same downside. And then increasingly importantly, one thing that multi-asset income approaches can bring you is dynamic asset allocation. And if I were to talk about how I see the investment landscape having changed over the last couple of years, well, that's a major area of change, and that dynamic asset allocation, to my mind, is more important than it has been in decades. So let's talk about today's income investing environment. Now, we've talked about cash rates going up, and you can see that on this screen here. This is the sharpest rate hiking cycle, frankly, since the 1970s and 80s. The good news is, even when the Fed is finished and they start cutting, it's unlikely that they cut back down to those zero or near zero rates. We are emerging from that era of super low rates. Why? Well, a major reason is inflation, and it's like compulsory for everyone to have an inflation chart, so this is my inflation chart. Now, this shows basically the breakout of inflation that we had in 2022, and 3 of those lines are actually coming down. So inflation has gone as high as 8 or 9%, but more fast-moving areas of inflation are well and truly on the way down. The problem is core inflation, the area that's focused on by the Fed, is moving slowly down, slowly. So for us, that means that we're more than likely going to see an environment where cash rates, even if they come down, they're not going to 1. The benefit of the higher cash rates that we see are, of course, bond yields. And I'm showing 10-year bonds and 2-year bonds here. Now, you're in an environment where 2-year bonds will pay in the US 4.8%, 10-year bonds will pay 4%. This is a really good foundation to build an income portfolio that can deliver a much more meaningful return. Now, our sense, and we certainly do, James shared a view only a few moments ago, that when you're close to the end of that cash rate hiking cycle, then it's typically a good environment to be adding duration into your portfolio. And that's something that an income portfolio can also do. It can vary its duration over time to try and protect capital in environments where rates are rising, but then also position for greater gains in an environment where you see rates falling, and you get to lock in those higher rates for longer. Now, let's get to some of the more interesting parts of fixed income. So here I'm looking at investment-grade corporates, and that's the blue line, and they're currently giving you returns 5.25% to 5.5%. An area where, again, James highlighted a very strong performer, typically after the peak in interest rates, and certainly that's an area where we see opportunity. High-yield bonds. High-yield bonds are currently paying 8.25% to 8.5%. That's an area where selectivity is incredibly important. Finding very good managers is incredibly important. These are great yields. 8.25% is a fantastic yield, but you need to have managers that fully understand the risks associated with each individual company. You need to have diversification because we are in a more challenging economic environment and one where default risks rise. So high yield, a good place to find select opportunities, but certainly not an area to be indiscriminately investing in. Another advantage with credit as we see it right now is that there's actually an opportunity to benefit from what's called the pull to par effect. So whereas in this last chart we were talking about yields, now what we're looking at is the average price of a US investment grade corporate bond, the average price of a US high yield bond. And they're all at about 88 to 90 cents in the dollar. Now, if you pick names and those names are going to pay back in your view, then ultimately all bonds mature at a capital price of $100 or par value. So what will tend to happen is as stocks, individual bonds get closer and closer to maturity, they move up towards $100 per face value of $100. So there are opportunities for capital gain as well through the bond market, as well as, of course, realizing yields that we think will be attractive on a go-forward basis. So pivoting a little bit and talking about equities for a moment. This is quite a complex chart, and we'll go through it in a sec, but you know, if I think about the story of 2022, obviously a difficult environment for investors, but one where what we saw was a meaningful derating in the market. Now, as we think about 2023, we've had the confluence of two different factors. Firstly, we've had a fall in earnings expectations that is ongoing. And just the way to look at this chart here, and this is a great pointer, thank you very much to the pointer people. So analysts start predicting earnings for a given year, probably about 2 years before. And what this chart does is it monitors the path of each year's earnings. Anything that is blue has the end point. So in 2016, it started at about 140 billion of EPS and it ended up at about 120. And what you see is typically every year, earnings expectations kind of head a little bit lower because we're all naturally optimistic people. Not the bond managers I know, they tend to be very pessimistic, but on average, equity guys, they're optimistic. Now what we find in recessions, and 2020 was a recession, is you get this massive fall. So the hope becomes really doom and gloom and then kind of gets back to the outcome. And 2021 was a bit like that as well. Now, 2023, we've seen earnings expectations continue to decline, and you can see those in the orange line. And we're starting to feel as though most of the bad news is increasingly in the market. So for us, when we look at equities, you know, that's a key consideration for us. So what we are seeing is part of that bad news in the market, most definitely, but then when we look at how the market has behaved, and I'm giving you another complex chart here, but we'll go through it in a sec. When you look at how the market has behaved, and you would have all heard this is a very narrow market rally that we've seen. There are still opportunities out there. So what this chart does is it looks at year to date, so the 6 months to 30th of June, performance by S&P sector. And you can see that information technology, no surprise, has done over 40%. Consumer discretionary comms around 30%. But you can also see a whole heap of sectors where there's actually been a small decline and quite a few sectors that haven't really moved too much. Now, on the x-axis, what I'm showing is actually dividend yield. And you can see that the dividend payers really haven't run away. Now, of course, showing a sector chart doesn't mean go out and buy everything in the sector in any way, shape or form. But what it does show us is that, yes, there has been a positive equity market movement, but there are still opportunities in good stocks in a broad range of sectors where there are attractive dividend yields and the capacity for performance. So when we look at the opportunities to build income from equities, we're seeing more and more opportunities. However, I would say that our focus remains more on the fixed income side. So to kind of summarize on a couple of things, for us, we feel that there are limited potential for further rate hikes. We believe we're hitting that inflection point where typically at the end of a Fed rate hike cycle, there are opportunities across all asset classes, across equities, across fixed income. There are the opportunities to outperform cash, to outperform more passive investment approaches. Inflation is slowing, but we are not returning to the world that we've seen for the last 10 years where inflation is an afterthought. Inflation is going to be a conversation, an active conversation, probably for all of this decade, if not longer. It will take time for the Fed to get inflation below their target of 2%. Most expectations really have them still in the 3s at the end of this year and into next year. In that environment, income levels will be supported by decent levels of interest rates. And then as we think about kind of the key areas of opportunity, where we see income opportunity, bonds really do offer standout opportunities. Interest rates for treasuries, you're able to lock in a strong rate for a meaningful period of time. Investment grade corporates, much like the HSBC view, really opportunities there. Within high yield, selectivity is critical. And then we also are seeing emerging opportunities in dividend equity paying sectors. So I'm going to pause there. Thank you very much for your attention. And I hope to see you and to have your engagement in the Q&A session later on. Thank you very much.
Thank you very much. Thank you, Mr. Pillai. Thank you. Thank you, sir, for sharing with us the income investing environment and its potential for us as well. Right now, we'll be ending our live web broadcast. Thank you once again to all our virtual audience joining us. Thank you. I trust that you have found our market outlook insightful for each and every one of you, and you have a clearer picture on how to navigate 2023. Thank you once again for joining us virtually.